Hi, everyone. Thank you for joining me for this webinar. Here, one second. Let me show my screen. Oh, okay. So my name is Brad Renard. I'm the Chief Publisher of Upside Options. Thank you very much for joining me. And if you can't see the slides moving, I'm just going to move to the next slide. Questions to address. You should see the bullets showing up. And if you can't see those, then just send me a quick note through the question pane. Okay. Okay, so the objective of this presentation is it's a broad market update. Let's look at the indices, the ETFs, some stock charts. Let's look at the economic data. I'll also give an overview of the non-directional Pinnacle strategy at the end of the presentation. So if you want to see that, then stick around for that. So right now, I just want to look at the charts. Are we at a bottom? What's this market doing? What's the economic data look like? What do earnings look like? Things like that. Okay, so questions to address. The high flying Qs and the NASDAQ composite. Those indexes are pulling back, so are we at a bottom yet? The S&P 500 index broke back below a major breakout of 3388. So how is that impacting the broad market? How expensive is this market? If the market continues to go lower, how low can it go before it finds support? What will be the best investment strategies for the balance of 2020? And also, how do you navigate through the election? And so we'll be looking at passive buying of ETFs, stock picking, covered calls, non-directional trading strategies such as Pinnacle. Should I sell some of my passive ETFs and stocks as this market pulls back? Should I add short exposure to my portfolio? Should I buy defensive stocks or ETFs or cyclicals? How about bond funds? And then I'll show an overview of the Pinnacle strategy, and I'll look at a past trade and I'll show the performance on that. All right, so I have about 5 minutes of a handful of slides, and then we'll jump into the meat of this presentation. So about me, I'm Chief Publisher of Upside Options. I founded the newsletter and the auto trading service in 2004. I'm Chief Investment Officer of QTR Capital Management. That's a registered investment management company, and that's targeted mostly to institutions. I'm an adjunct professor. I teach at Chapman University, the Argos School of Business and Economics, and my area of focus is statistics, econometrics, and analytics. I've been in high tech, no longer in high tech, but I was in high tech for 25 years. Silicon Valley. I started off as an electrical engineer at the GE Space Division. That was on the East Coast, New Jersey. I'm now in the West Coast in San Diego. I was then in marketing, sales, VP of sales, marketing, co-founder, lots of different roles in myriad companies. My primary company for a long time was Cadence Design Systems, and then lots of smaller companies in that space. That's chip design software, all the software used by electrical engineers to develop semiconductors. Also, I was in Japan for a couple of years running a branch office for one of the companies. My education is in physics, electrical engineering from Columbia, and an MBA from Chicago Booth. So here are the returns for Pinnacle, and it's doing pretty well now. So we went through 4 months of trying to navigate through the crash, the COVID crash that started at the end of February. And that's about right. I figured from how deep and intense and how violent that crash was, and that was one of the worst crashes I've seen in 25, 30 years, that it would probably take me 4 months to navigate through that. And I did. And now it's back to normal, but it's actually not normal. It's even better because volatility is still elevated. So I'm able to bring in wider iron condors and big chunkier premiums. And so I should be able to generate 7 to 10% a month now through the end of the year, as long as the volatility stays elevated. So it's pretty nice. So last year I was up 36.8% for the whole year. This year it's right now up 19% realized. And usually I'm trying to target 25 to 35%. And I should be able to hit that. Crossing my fingers. I take it month by month. I have the whole year to hit my target, and I've lost 4 months, unfortunately, through the COVID crash. So that's not good, but I'm trying to catch up. All right, so the available strategies through Upside Options. And upside options is targeted to retail clients. Smaller amounts can be invested in 10K increments. And so any of these strategies can be used by any clients that have at least 10,000 to invest. We have big cap growth, small and mid cap growth, sector rotation. That one's buying the strongest stocks within the strongest industry sectors. Contrarian, that's buying stocks that have been out of favor for 6 to 12 months. Diagonal covered call, this one's coming soon. It's basically we're buying leap calls on a basket of high quality stocks, and then we write calls to bring in premium. So a leap is a long dated long call on a stock. So instead of buying the stock, we'll buy a call on it. And it's usually good for 9 months. And then we keep it alive where we want to keep at least 4 months to expiration on the call. And then we keep on writing calls against it. And then if a stock gives us a particular trigger, we will stop writing calls and we'll let it run and make a gain just purely on direction. So this one's really a blend of directional and non-directional or writing calls. Iron Condor Pinnacle, I'll talk more about that. That's a non-directional income generating conservative all weather options-based strategy that typically generates 3 to 5% per month. Leveraged dividend income, this one is new. And this one is we purchase a basket of concentrated stocks. Concentrated basket of high quality dividend paying stocks. We then lever up those stocks about 3 to 4 times. And we're levering up the dividend also about 3 to 4 times. And it generates about 10 to 12% annually. And it's a very elegant, interesting, unique strategy that you're not going to find anywhere else. And you can replace a bond fund with this type of strategy because you can get out at any time. It actually generates higher returns and it doesn't have interest rate risk. You own a bond fund trying to make 5%, 3%, sometimes maybe up to 7% if you're lucky. If it's a high yield bond fund, then you have interest rate risk, and interest rates start going up, you start losing money. And so this actually solves a lot of those problems. Okay, a couple more slides, then we'll jump into the meat of looking at the charts and looking at the data. So for the stock strategies, we do 4-level quantamental analysis. We blend technical, fundamental, factor-based quant. We're long short, primarily long on the stocks, and then if we do short, we're just going to do macro level shorts, meaning just buy a put on the SPY or any other broad index trying to help protect the portfolio. And we have a unique methodology that makes the short trades almost for free. So we follow strict exit rules. We're able to let most of the winners run, but we can move fast enough to lock in the gains and to protect capital. So perfect example, October 2018, that market pulled back really hard. We went from 75% allocated to 15% allocated in less than 6 days, finished off the year with nice gains, and the benchmarks got clobbered. We were up plus 18 to plus 25% for the year for most of our strategies and for all of our strategies, and the benchmarks were all in the negative. So we just follow strict exit rules, and a stock can be a darling and can be a Wall Street favorite until it's not. All right, I'll repeat that. A stock can be a Wall Street favorite until it's not. And then when it's not, everyone stops talking about it. Most people are left holding the bag, and then that stock no longer is gaining. It's most likely pulling back 5, 10, 15, 20%, and then it stays down for a long time. So you have to move pretty fast on taking gains and not getting greedy, especially on the Wall Street favorites, the darling stocks. Okay, just broad here. For the 4-level scanner we use, we do a macro analysis. We do technical, breadth, fundamental, sentiment, and that's kind of modulating how much bullish or bearish exposure we want to take. Then we do a technical scan. We're finding high probability setups. Then we do a fundamental scan, looking for strong companies, mostly for bullish trades. If we're going to short a company, which we rarely do, but if we want to buy a put on a company, then we're looking for weak fundamentals. But mostly we're looking for strong companies. And then we do a quant screen, and I'll show you what that means. It's a quantitative screen. It's using econometrics. And then we use technicals to trigger entries and exits. We allocate 4 to 5% of the capital to each position. So a typical portfolio will have 20, 22, 23 stocks maximum. So when we say econometrics and quant, this is what it really means. The use of econometric statistical mathematics to provide predictions such as the probability that a stock will break above or down through a particular level, probability that a stock will move a particular magnitude up or down once it breaks through a level. And this requires a couple of years of education in statistics, econometric math, along with a couple of years of learning how to optimize models. And it creates this. So we kind of run about 3,500 stocks through a statistical model, and it's called a factor-based model. It has about a dozen factors in it, and you end up with all these probabilities for all these stocks. And that gives us more information when we're stock picking. Okay, so that's quant analysis. Okay, snapshot of current market. Let's go ahead and get into the market. So we had a COVID crash. The overall market was down 35%. Some stocks were down as much as 50% in early March. That was one of the fastest, deepest, most violent crashes that I've personally seen in 25, 30 years. It wasn't helpful that the market was at an all-time high. It was expensive, trading at 19.5 times earnings. And man, when you got a crash that comes when the market's already peaked, that's ugly. So most stocks have rebounded, 80% when you're looking at the good companies. Some fully recovered and some broke out to new highs, especially the stay-at-home plays, Home Depots of the world, or anything that's online, Amazon, Zoom, of course, anything like that. All these stocks have just gone, they went crazy. They went straight up. They were up 2 times, 3 times your money. So the Qs and the NASDAQ composite got extremely overbought. SPX broke up about above 3388. SPX is the S&P 500 index, as you probably all know. The ultra cap stocks hit all-time highs, the Apples, the Amazons. Tesla, I'm not going to call it an ultra cap stock, it's not, but it's just one of those crazy cult stocks that just everyone loves and they want to stay in and they're in. Now the market's been pulling back over the last 2 weeks, about 9%. And in general, for this market, it gave us an opportunity to make some money. It's kind of a one-off. Anyone that bought in March and April, they did well. Most companies, if you bought a decent company with decent earnings growth, it was up 35 to 70%. Personally, for the big cap, I booked some of those profits already. Once they started hitting the pre-COVID highs, I got out. And then some kept on going. Actually, a lot did. For the big cap strategy, so we bought many in March and made some good money. The non-directional strategies, when you have huge moves, 35% down in 3 weeks, we're not going to make money in Pinnacle. No way. If anything, we're adjusting. We're going to have small losses, trying to keep the losses under 5% a month, 3% a month. Moving trades, and then if the market starts just screaming higher and rebounding with a V recovery, that's also tough. It's just too big of a move for a non-directional strategy like Pinnacle. So I'm doing a lot of trading, a lot of adjustments, trying to just stabilize everything and waiting for the market to stabilize. So as of mid-June, early June, we're pretty much back to normal, but we're bringing in higher than normal premiums because we still have elevated volatility, and that's a positive. Okay, let's look at the charts. Here's the NYSE composite. This one tends to have more conservative companies in it. So when it rebounds, it'll kind of get back up in this range here, but it doesn't break out and take off like the QQQs. The QQQs, that's 100 of the biggest technology companies, including Amazon in there, which is a big chunk of it. Amazon, Facebook, Netflix, Apple, Microsoft, those represent a very large chunk of some of these indexes, and that does create a problem. I'll talk more about that. But you can see how violent this correction was. This was 2016. Here was the election, trended up, started getting sideways and choppy. We had one correction at the end of 2018. And then we had the COVID crash, and that was about 40%, 35, 40% on most of the indexes. And this one's pretty nasty. It went all the way back down to the election level, 2016 level. So that's an extremely fast and violent crash. I don't think I've ever seen anything quite like it. The small caps, same thing. When it crashed, it went all the way down and retested the lows of the election of 2016. Okay, this is the chart we really care about. So the S&P 500 index, here's the election here, trended up, kept on taking out higher highs, crashed about 35%, took out a higher high up here. It did. Now we're back below it. So this is interesting, and this creates complexity. Trying to figure out what this market's going to do next is a lot tougher now because we just failed below 33.88. And we can talk more about this. It's like, this is not good. This is not good. This is very significant. We came down to 3,200, which was my last call. I'm like, yeah, we're probably going to have to come down to 3,200 before we find support. And we did, close, about 32.10, 32.15, something like that. And we'll have to see. So I'll talk more about that. Here's the Dow, same thing. Here's the election, trended up, got really choppy. This was all of the China mess. This was when Trump started just taking on China with the trade war. It really chopped the market and whipsawed the market for 2 years, year and a half. It was just a mess, absolute mess. Here's the crash, 30, 35%, rebounded. Now here's the high. We're probably going to get up to this high. We're not there yet. Here's volatility. This is a weekly. By the way, I was showing weekly markets. I'm sorry, I didn't say that. These are all weeklies. So this is a weekly price chart. I'm showing the 17, I'm showing the 43 EMA, exponential moving averages. And so that's why you can see back so far, every bar represents 1 week of trade. This is the 17-week EMA. This is the 43-week EMA. This is an excellent, bigger picture moving average to follow. I would follow these two moving averages. Whenever you see the 17s above the 43, it tells you that the market is in a long-term confirmed uptrend. Whenever it breaks below the 17, it tells you the market is a long-term confirmed downtrend until it changes. So this is something that is good to watch. Okay, now we're going to, okay, we're still in weekly. Look at the VIX. This is VIX, this is volatility, applied volatility for the S&P 500 index, went up to 85. The last time we saw this was in 2009. So this is a huge spike, and that just creates all kinds of problems with the market. Here's the 10-year note. 10-year note was up around 3%. Now we're down at 0.6%, 0.67%. And the COVID did not help. Everyone just piled into bonds and got out of stocks. In general, it's not wise to be owning bonds. I believe the bonds are going higher. I mean, we're going to get through COVID. There's plenty of liquidity in the market. Some people are saying interest rate could go to zero. Well, they could. I don't know. I believe that interest rates have found a bottom, and it's a good idea to be out of bond funds and probably stay in equities. We'll talk more about which equities. This is corporate earnings. This chart right here is from FactSet. If you want to get your own earnings report, just go to FactSet Earnings Insight. You can type that into Google, FactSet Earnings Insight. And this is forward, stark line, forward 4 quarters projected earnings for the S&P 500 companies, 500 companies within the S&P 500. We're at about $155 worth of earnings for the next 4 quarters. The blue is the S&P 500 index. You can see it went straight up. Now it's pulling back a little bit. So that's represented over here, like 33.40. Actually, we're down lower than that. Actually, this is an older chart. It's not showing where the S&P is right now. Okay, so earnings got hit hard from COVID. The S&P 500 companies are now projected to generate $155 of earnings over the next 4 quarters. Market's trading at 21.4 times earnings. So basically take where the S&P is trading at, 3,200, for example, 3,300-ish. divide by $155, and that will give you a PE ratio of where the market's trading. It's trading in 21 to 22 times earnings. That's extremely expensive. Market is classified as very, very expensive. All right, the economic data. Usually I'll look at a lot of economic data. This time I don't really need to because it is so mangled. Because COVID is just so extreme and shut down the economy. And of course, up to 30 million people went unemployed. I think we're sitting at 12 million. But if you add in other types of numbers in there, what people don't really talk about, we've lost over 4 to 6 million people. I think maybe it's four, or maybe actually I think it's 6, have left the job market. They've just left the jobs market altogether. And so you have to add that in there also. So, we could be still around 18, 19, 20 million that are unemployed. And so the unemployment rate's coming down. It's showing right now around 8%. Non-farm payroll, some of these jobs are coming back. It's still a disaster. Unemployment claims, new claims for unemployment, that has been dropping, but it's still near 800 to 900,000 weekly. And about 29 million people are collecting some type of unemployment. Doesn't mean that they're not completely out of work, but there is some, there's other types of programs out there and partial programs for people that are underemployed. So there's I think it's 28, 29 million people that are still collecting unemployment. Retail sales, which drives about 2/3 of our economy, is bouncing back a little bit. It's bouncing back. People are spending. A lot of it's going to Amazon, so they're doing well. And we'll just have to take it month by month. Let's look at the worldwide charts. Here's Europe, Germany, emerging markets, China, and then the world X the US, so not including the United States. And most of these countries have done much better with the virus than we have. We're pretty much a complete disaster. And other countries have figured it out, and they haven't politicized it and made a mess out of it. And so Europe is climbing. And so any of these actually could be, if someone wants exposure in Europe, buy IEV. This one's back over the 50-day line, I'm sorry, this is the 200-day line. This is the 50-day line, which is the blue. It's crossed up over, which is good. It'll probably get back up to here and then start hitting resistance. But this is a good position to own. Germany actually broke out above an all-time high. Here's FXI. This is China, and this one's bouncing all over the place. You can actually trade this a little bit. If it comes down to the 200, pick some up, or even pick some up now, and it'll go back up to there. And emerging markets, because the dollar's falling, the dollar's getting cheaper, and that's good for emerging markets and for commodities. And it's actually breaking up. So actually I own EEM in one of the funds. I have been looking at IEV. I haven't bought it yet, but I might be buying that one. And you could trade this one. So seems like everyone else is doing okay. Now United States, of course, our stock market was zooming, but it doesn't mean that that reflects the economy. The stock market is not the economy. They're two very different animals, and the economy is struggling right now. Okay, let's look at the charts, the Qs, 100 of the largest technology companies. We can see that it got extremely overbought. It's pulled back. Does it mean that it's going lower? Not necessarily. And Amazon, Facebook, Netflix, Google, Microsoft represents about 40% of this index. So it is very skewed to those ultra caps, darling stocks. And whatever they do, that's what this index does. So right now it's pulling back. It's kind of finding support right here. We'll see. If this starts going lower, that means those big darling stocks are going lower, and that means the entire market's going lower. Right now the market's down about 8, 9, 10%, just depends on what you look at, and we needed the pullback. This is healthy. NASDAQ Composite, same thing. Lots of high-flying NASDAQ stocks, a lot of software companies in there. The Zooms of the world is in there in the NASDAQ Composite. They just went straight up. Shopify is in there, one of those high flyers. One thing to watch is I show the 13 EMA. And I show the 50 EMA on all of these charts right here, the 13 and the 50, and then the 200 is this dotted line. If the sell-off gets severe enough, and it could, because the uptrend was so extreme and so overextended and so overbought that usually these types of pullbacks need to continue until a lot of these stocks and indexes come back down to the 200-day line. Usually. Not to say it's going to happen, because sometimes you can find support at the 50 and this thing might go sideways now for a long time. Are we going to go out and take out new highs? Well, I doubt it, but because Amazon represents a huge percentage of this, you never know. It just depends on what Amazon does. And Apple, those two companies alone is like 20% of this index. So normally, if you didn't have these high-flying ultra cap stocks that have market caps at $2 trillion, we never had this before. Normally, this index would probably come back down to its 200-day line. S&P 500 index, we can see it broke above 33.88, rolled over. The 13 is still above the 50. We have not got across yet. So we could find support here. My last advisory said that we needed to come down to 3,200 before it would find support, and it would most likely find support at 3,200. So I still believe that. I think we're going to bounce from here. Are we going back up to 35.80? We could. Are we going to break above 35.80 and keep on going? Well, I don't know. We could in the future. I just don't think it's going to happen for many months. And what I do is I trade it. So I'll trade this, I'll put calls up here, at least for Pinnacle. I'm selling calls way up here and I'm selling puts down here, and I could make a lot of money for many, many, many months. And so this is what I look for. I look for an index that finally starts creating a range, starts getting a range bound, and it probably will. It will probably stay below here, the 3580, 3600, and we'll probably stay above 3200. And I don't think we're going to be coming down to the 200-day line, but we could, and then we just have to adjust accordingly. The Dow up has not hit the all-time high. It's kind of in this range. It'll probably stay in this range for a long time. Small caps, this looks fine actually. They climbed, got up to here, 160, hit resistance. It's staying above the 200-day line. The 30 is the 15, 13 EMA is still above the 50. This looks normal right here. This looks actually pretty healthy. And the NYSE, same thing. Went up, hit resistance at this 13,246. It pierced down through the 50, that's fine. It's finding support at the 200, and that's actually pretty normal. Breadth is very important to watch, especially this breadth indicator. It's one of the few leading indicators out there. This is cumulative advanced decline line. You can get it in stockcharts.com. And basically each point represents daily how many stocks advanced versus how many declined. You add them together and then you get a number, and then you add it to the existing cumulative number. And so what I show is a 20 and a 40 on this one, moving averages. And on this one, I show a 17 and a 40 moving averages. And whenever these moving averages cross, that's not a good sign. So the NASDAQ has definitely been running out of juice. Breadth has been weakening. It's been rolling over. We can see it's rolling over. This will weigh on the markets. What it tells me is that the probabilities of really climbing and rebounding all the way back up to the highs is not going to happen for a while. It'll try to, and people will pile back in and try to push it up. But when you see breadth that looks like this, we're going to be hitting resistance at some level, and that's actually good for traders like Pinnacle. So I'm watching this, and I'm watching calls that I can sell, and this is perfect for this is what I like right here. When you see just a advanced decline line going straight up, it's good for stocks. You just buy stocks and then try to take your 20, 30, 40, 50% gains when you can, and then don't get greedy and book your profits because it's not going to last forever. But this is when a market just kind of goes nutty and everyone's just piling in. Here's the S&P 1500 advanced decline line, and this one's looking even worse. Now this one includes everything. It has the small caps, the mid caps, the large caps. The mid caps were really getting hammered hard, I noticed. So this line's ready to cross over. I got a 1350 EMA on this one, and it's telling me that the broad market has weakened. Has it found a bottom yet? I don't know yet, but probably, because the SPX is the one that really dictates that. And I said, as I mentioned, like last week, my analysis told me that we're probably going down to 3,200 intraday, and that's what we did. And then we'll probably bounce. Now, just knock on wood and cross your fingers that we can find support there. High yield bonds look fine. This pays about 5%, but look at the risk that this fund was down quite a bit during the crash. Now it bounced back, and this is all like double B bonds, or I think it's double B bonds or lower in quality. So that's kind of like junk bonds. Here's high quality investment grade bonds from corporations, and everything looks fine here. So the bond market's telling us that everyone feels comfortable in the company's abilities, all these companies that borrow money, in their ability to continue to pay their interest on their debt. Okay. Okay, market sectors. Let me just check to see if there's any questions coming in. Okay, I don't see any questions. Market sector analysis. I use etfreplay.com. It's not too expensive. It's like 30 bucks a month, and you can actually generate these types of market sector rankings. And it's just ranking markets, different sectors. And right now I marked all the ones that are kind of cyclical in nature. So we got transports, industrials, steel, global steel. Now this one has a lot of moving parts, but it represents building and construction and expansion of a global economy. Automation, robotics, consumer staples. I probably shouldn't have not marked that one. Financials, you usually want the banks to be working and the banks lending and expanding an economy. So financials, home construction, building and construction, and just the broad S&P 500 index. So this represents the top 46 of about 85 sectors that we watch. And then this helps us with our sector rotation analysis. When we're doing sector rotation analysis, we'll look at all the different underlying stocks, especially in these top 20, and jump in on those stocks. They're usually climbing, and they'll usually climb for a good month or two. And then you take your profit. They'll climb for up to 10, 15, 20, 25. You can get 30% out of a stock. You're doing pretty well. And then you take your profit on those. And a lot of these stocks will run for, again, a couple months, 2 or 3 months. And then all the money rotates out of that sector, and then all the money goes to the next sector. So you'll see that these industry sectors change around a lot. For defensive holdings, actually one other thing I just wanted to state here is that you'll see a lot of value is here. Here's the S&P 500 value. Here's the Russell midcap value. Here's another large cap value. What that's telling me is that all of these high flyers got way overextended, way overbought, and money now is starting to flow into companies that didn't climb as much. So those are all the value stocks, the stocks that didn't zoom up, like the Amazons and the Googles and the Facebooks and the Apples of the world. So this tells me to start looking more at the value stocks, and then you have to, got to put some work into it and you have to have some tools to be able to help you find those stocks. Defensive holdings, gold, silver, 10-year treasury, consumer staples. So we can see that gold took off, got up to its 2011 high. This was very impressive. So for all the people that are holding gold and buying gold, now, by the way, I'm showing a weekly chart here, and here's how powerful the weekly chart is. Build weekly charts on something like gold and bonds, for example, and silver. And when you see the 17 is below the 43, do not be buying any more gold. But you'll still see all the commercials on TV. You'll see still people talking about buy gold, buy gold, buy gold, because it's a business. And you have a lot of people that don't really know what they're doing, and they were buying gold for years, and it did nothing. And so if you spend a lot of money and put a lot of your assets into something, you want to make sure that it just doesn't sit there and do nothing. And when that 17 is below the 43, you're not going to make much money on it. Now it broke up through here, but then you want to draw a line across, always draw horizontal lines, and draw a horizontal line across these highest levels over here. And once you get a breakout, different story. Now, if you want to start accumulating gold, go for it. So make sure the 17 is above the 43 and make sure you get above one of the horizontal lines. That's wise then to start accumulating that asset, whether it's gold, silver, bonds, things like that. So people who finally, if you did it right, they were in here accumulating, and then they actually took advantage of a nice run. Okay, the 10-year note, we're down to 0.6%, so you're making hardly anything. And after inflation, you're pretty much at zero. Staples, this looks okay. It's pulling down. Now it did break below this all-time high. That's not great. I probably wouldn't be getting into any of the staples right now. You know, the Procter & Gamble's. I think Clorox just zoomed up, almost like Zoom, for example, just because of the nature of COVID. And that one was really helping to take this index up. But I would probably pause. I would want the consumer staples to get back over 65. Again, always draw a horizontal line, put it right on that breakout. And if this 13 is below the 50, you really don't want to be buying anything yet. Wait for the 13 to get back above the 50, and then wait for it to get above a horizontal line. Because if not, you're just going to buy stuff and you can sit on it for months, if not years, and not make any money. Just like all these people who bought all this gold. Look at this. 1, 2, 3, 4, 5, 6, 7 years, 6 years, it just did nothing. And you just don't want to do that. Now, if you want to hold gold coins, because if you think, you know, we're going to end up with a complete collapse of our economy and the currency and things like that, that's a different story. So if you want to own some gold coinage and put it in a safe or somewhere, yes, I understand that. Okay, silver was popping up also. Now, if this stays over this level, this could go higher, but I don't know yet. Gold already got up to here, and I have a feeling it's probably done running. Okay, industrials look pretty good. We had a nasty pullback. This is not from today. This was from yesterday, but everything was up about 0.5%. So everything was up a little bit, but the chart looks just about like this. Industrials look okay. We're over the 200-day line. 13 is over the 50. We're banging up against this high here, which represented this. Always draw your horizontal lines. This line represents this low here. Once we get over 80, this is good for industrials. So if you want to start getting into, you know, Train and Black & Decker and, you know, Illinois Tool and other companies that are big industrial companies, you'll probably make some money. KBE banks got hit yesterday. I guess there's another COVID scare around the world. COVID is increasing. It's just hammering the banks. JP Morgan's pretty much the best one out there. All these charts look the same, whether you put Citibank up, Bank of America, JP Morgan, Goldman Sachs, all these charts look the same. If you really want a bank, buy JPM, but you know, until it really gets over a particular horizontal line, don't buy it. It could stay below that line for a long time. And look at this downward sloping 200-day line. The banks are just getting hammered still. XLY, consumer discretionary, this looks pretty good. Unfortunately, Amazon represents a huge percentage of this index. So you have to be careful on some of these indexes these days. If you are looking at an index, just make sure you understand the components in it, and you know what percentage is Amazon, what percentage is Apple, Microsoft, Google, because those companies are just so big now that they just mangle these indexes. RYT, now this is an equal weight tech. That's why I'm watching it. So it's equal weight. So you don't have the Apples completely overbearing the index. And you know, everything popped up and now broke back below this high. So this is not great. It just tells me that we could go lower or go sideways and choppy for a while. IYT transports look good. Okay, I thought I showed that one already. But it broke below, but we'll see. At least they're up there telling you that rail and air transports for goods and trucking is doing okay, and that's good. That's a leading indicator for the economy. SMH, semiconductors, 13 still above the 50. It got very overextended. NVIDIA is a big piece of this. Advanced micro devices, there was just some high flyers that really made this climb hard. But overall, when the semiconductors look like this, that's a good thing for the economy. Okay, here's the Microsoft, here's Apple, here's Facebook, here's Amazon. They're all pulling back, but they look okay. Everything looks good. If they break below the 50, then they're most likely going to come back down to whatever horizontal line you drew, like for example, this support line. So it's always wise to not get into a stock until it comes down and finds support at a horizontal line, especially if it breaks below the 50, and especially if the 13 breaks below the 50. Same thing with Facebook. Good chance that this one could come down into here. Apple, man, this just went so parabolic that it probably is going to come down. I have a line drawn here. This is a trend line that goes back many years, and it just shows how much it got overextended. Amazon got majorly overextended. It'll probably come back down to somewhere in here. Okay. I always want to watch the high flyers to see where the money's going and how crazy people are for that particular week. And so we had Shopify, which is an extremely fast growing company. Anyone that knows anything about and invests in momentum stocks, they owned Shop. And so I always watch it. So now I can see that 13 is below the 50. It's going to start deflating because it inflated and got extremely overextended. Always watch MasterCard, watch a Visa, see how it's performing. Watch a Tesla. You can just see how hot the money is out there. Boy, this one is still very sticky. It's pretty amazing. So, always, on a daily basis, I always have to see, what's Microsoft doing, Apple, Amazon, Facebook, Netflix, all the kind of the big ultra caps because they drive everything. And then of course, I want to see what the high flyers are. And there's a bunch of other, software companies and tech companies that have done very well. Of course, Zoom Video, I want to see what that one's doing. Okay, some just other indexes that could be opportunities, and these are almost identical to my last presentation a month ago. It hasn't changed too much. So if you want to get into airlines, think about Love, Southwest Airlines, or think about Jets, which is a ETF, so you don't have to worry about bankruptcies. We could have bankruptcies. We could still. I mean, their flight the number of flights daily is still down 80%. So these companies could go bankrupt. Delta Airlines, DAL, I've been watching, UAL, but if you just want to be taking advantage of a beaten down industry that hasn't come back yet, Jets could be a place to do it because that's just an ETF. So if someone goes bankrupt, it will impact this, but at least you won't lose all your money by buying a single stock. Carnival Cruise Lines, I personally do not want to buy this stock for any of the funds. Just too risky, and no one really owns them. They're like, I think they're licensed and they got in Barbados or something like that. So no country's gonna come in and bail them out. And if they can just keep enough cash and get through it, then this will get back up to here. You'll probably 2-3 times your money. And then oil's been ugly for a long time. Chevron is a good company. It's one of the better ones out there. One of these days, oil will bounce. It just hasn't bounced in a long time. Cisco, SYY, they deliver all the food to the restaurants. It's still a buy. It's finally coming back. This is the biggest player, so they probably won't go bankrupt, but you never know. That is the risk for these types of companies. And until restaurants fully open, I'm sure their volume is down 50, 60, 70% of the food that they're delivering to restaurants. Boeing, still way down here. One of these days, it's going to be back up here. Just don't know how long. Darden restaurants, they have a bunch of different restaurant chains. Olive Garden is one of them. The Yard House is another one. So all the restaurants are pretty cool. Very nice, interesting restaurants that they own. They have like 1,800 different restaurants. One of these days, this will be back up to here. lower probabilities that a company like this will go bankrupt, but you never know. They could reorganize and the stock goes to zero. Here's JP Morgan Chase. You can do either a KBE, which is the bank index ETF, or you can do some individuals like a Citibank or a JP Morgan or a Bank of America. JPM is an excellent company. It just pulled back a little bit. So you could accumulate. Just how long will it take for these companies to come back? I don't know. Gambling, MGM Resorts, Wynn, anything that's gambling. I mean, that's just something we can't bet against. You know that there's always clients, customers that want to go gamble and stay in those hotels. So MGM, one of these days, will probably be back up to here if they don't go bankrupt. Same thing for Wynn. Here's Europe, looks pretty good. They're doing much better with the coronavirus than we are. Here's insurance, and it just pulled back nicely. So insurance will probably come back down to here. Insurance is not going anywhere. One of these days, this will be back up to here. Real estate services, CBRE Group, same thing. Ross Stores, these are all the discounters, Ross, Burlington Coat, BURL. Those are always good companies. They're not going anywhere, and they have a big moat around them. Amazon cannot take any of their business away. So one of these days, Ross is going to be back up to its highs. Okay, so the questions to address. Let me just see if there are any questions right now. Nope. The high flying Qs, that's the NASDAQ, that's the Qs, the 100 tech companies, and the NASDAQ composite, they're pulling back. Are we at a bottom yet? I think we are, primarily because of the S&P 500 index came down to 3,200 intraday. And if we go back down to 3,200 again, that's not good, because you don't never want a triple bottom of anything. Well, it would be a double bottom, and that would be okay. So if we double bottom at 3,200, that could happen intraday. If we go down there for the third time, then we're going lower. But I think the probabilities are increasing that we're finding a bottom. So the S&P 500 broke back below 3388, a major breakout level. How will this impact the broad market? Well, that's kind of past tense now. Once that breaks below 3388 and then the S&P broke below the 50-day line, that's not good. That's what took it down to 3,200. How expensive is this market? It's very expensive. We're at 21 and a half, 22 times forward earnings. That's not sustainable. So I don't know when this froth is going to come out, but right now the market is looking forward 6 to 9 months and predicting the economy will recover in the next 6 to 9 months. And the stock market is not the economy. So the stock market is a forward-looking mechanism, and it can get very expensive and stay expensive for a long time. The market continues to go lower. How low can it go? Where will it find support? I think the SPX 3200 is that number. What will be the best investment strategies for the balance of 2020? Well, heading into the election, I think that we're not going to be taking out any new highs. I think things got so overextended already that everything pulled back. Those are probably the highs through the end of the year. And if Trump gets back in there, maybe we rally again. If Biden gets in there, maybe we pull back. We could. We probably will pull back short term. He's going to cut that corporate tax rate almost immediately, and he's going to take it from, I think it's at 21%, push it back up to like 26 or 7%. That will impact earnings. The last I saw was maybe by 8 to 10%. And that will impact the market. So the market's going to have to reprice for that, and that's going to create some chaos. So we have to be very careful with that. All right, so passive buying ETFs, stock picking, non-directional trading. I think for buying stocks that are still recovering, those are safer. Stocks that have, like the Apples of the world, I got out of those and already booked my profits of the Microsofts and the Apples. I'm not buying any of those high flyers. They could go a little higher, or I don't think they're going to go any higher. They're not going to take out higher highs, but could they rebound? They could. I just don't like the shape of the charts at all. When you look at the weekly charts, they're just straight up. So I don't touch those. I'm looking more for fresh breakouts. and I think those are safer now. And if you want some help with that, contact me, or you can follow one of my advisories, because I do more breakouts. So I'm looking for stocks that take out some higher highs that have not already broken out. And so those, you can make some money on those. So that's basically stock picking and new highs from brand new stocks that have not been going straight up. And then a non-directional options trading strategy. Yeah, I love Pinnacle right now because I made 20% in 2 months. And then, so when the market gives me an opportunity, I make a lot of money. And then all of a sudden we pulled back. So I'm not going to make anything this month. I'll be probably down 1 or 2%, but I'm almost through it. And in the next week, I should start opening fresh trades again and bringing in some nice big premium. And this type of market now is going to be sideways, choppy, and sloppy, where it's better to trade it. It's better to trade it and just book profits on some of the big gainers you have. So I sell some of my passive ETFs. If they went straight up, like the semiconductors, yeah, SMH or the stocks, take your profits. The apples, take your profits. You should have already. I just don't like holding when you look at the weekly chart, it's horribly overbought. Should I add short exposure to my portfolio? No, probably not. You don't want to short this market. You want to trade it, but not short it. I'm not going to be shorting anything right now in any of the portfolios. Should I buy defensive stocks or ETFs or cyclicals? I would focus on cyclicals, because we're going to get through COVID. We're going to get through it. And I think all of these companies are going to continue to, I think the money will stay in a lot of these stocks. It's just you have to be patient with it, and you want the stocks to come down, and you just don't want anything that was horribly overextended, like an Apple, for example. Home Depot, let it come down to its breakout level and then get into a Home Depot. I mean, because those companies will still continue to do well. Just let it come down and let it take a breather, and because they're just horribly overextended. Bond funds, I wouldn't touch bond funds, because interest rates, I think they're going higher. Sometime in the next year and a half, I think interest rates are going higher, and these bond funds are going to get hammered, because we're already at a 0.67. We got as low as 0.5 for the 10-year. Just don't like the funds. So if you want something that actually generates, straight income, that's where our leveraged dividend income comes in. We're actually extracting dividends. So it's a good product that kind of replaces money that's put into bond funds. And it generates more. We're generating about 10% annually on it. Okay, so let me just summarize kind of where we are with the S&P. I think that 3,200 down here is probably the bottom. If we start breaking below 3,200, then yikes, we're going down to the 200-day line, or even down to 3,000. I just don't think that's going to happen. I think we're finding support at 3,200. So I think the SPX and most of the market now is going to trade kind of between here, and it could break back up above 33.88 and get back up to its high. And I think it's going to trade range bound for a long time. And that is perfect for trading strategies. It's a lot more difficult for buying stock, unless you're just really long term. Okay, any questions at this point? Because I'm going to jump into a couple slides on Pinnacle. Okay, so Pinnacle, this is a trading strategy, and it's really optimum now. It's no fun during a crash. It creates a lot of work for me. I have to move all the trades down, adjust them all down. I'm usually booking 2-3% losses every month. Now that's not a big deal, because on a winning month I can make 10%. I can make 8% on a winning month, and I got many winning months out of the year. It's just how often do you have a COVID crash? So that was 4 months worth of adjustments and waiting for volatility to come down. And it's just a lot of work for me, because I had to move a lot of trades. But it's finally back, and it's good. So Pinnacle is a conservative, non-directional, income-generating, all-weather strategy. It's optimized and adapted to the new political era that we've been in since 2017. It can handle the volatility that can come out of Washington, D.C. And it can generate positive monthly returns in upward trending, downward trending, or sideways and choppy markets. I think that's exactly where we're heading into now. We hold a maximum of 3 to 4 positions at any one time, so that's 30 to 40% exposure for the portfolio. So if it's a $10,000 portfolio, only 3 to 4K is being used. And that's the big adjustment that I made for this new political era. I used to be running at 70% allocated, sometimes 80, 90% allocated, and I could do that. I did that for many years. I've been doing this strategy since 2004, 2003, and Trump just changed everything. And he was whipsawing the market, and especially when he, started his battle with China on trade. It just was a mess because he was just whipsawing the market on a daily, weekly basis, and with his tweets. And so I really had to lower the exposure level down quite a bit. But actually, I like it. It's good. I can still generate some pretty nice returns, and it gives us plenty of cash to maneuver, and we can handle some crazy markets. So each position represents 10% of the portfolio. Each position is open for 2 weeks. We hold enough of the cash in the account to make trade adjustments when volatility unexpectedly rises. Translation, a tweet Sunday night that completely just, moves volatility by 40% in one evening from a tweet. Never had to contend with this before. The strategy is conservative by construction. It allows us to sleep well at night because we have a low level exposure. So we're still able to, but we're still able to generate some nice, decent gains. I can still hit my 25 to 35% a year. That's my target usually for the year. Targeted returns is about 3 to 5% per month. And for the balance of 2020, it's going to be higher because it's going to be closer to 7 to 10% per month due to the elevated volatility, and it's still not coming down. That volatility is staying around 25. VIX is staying in that range, which is nice actually. Capital preservation and safety are a top priority, and I'm the guy that does it, and I have about almost 18 years of experience in trading this strategy now. All right, so here's a trade. And let me see if any questions are coming in. Okay. All right, so here's an underlying over here. Now this is an old trade. This is an October 2019 trade, and we're opening up a 3010.20 call, and we're opening up a 2855.45 put. And this is on the SPX. Here is the underlying over here. This is the SPX trading as a function of time. This is May through September. Just forget about these bands here. These are volatility bands. So the underlying is here, moving. And here, this blue line is where the underlying closed for the day. So it closed at 29.51 right here for the day. And what I'm doing is I'm selling a 3010 call. So it closed at 29.50. So I'm above. So 3010, I'm selling that call, and then I buy a 3020 call for protection. That's a 3010, 3020 call spread, bear call spread. And that brings in a premium. My product that I'm selling are these short calls and puts right here. So whenever the market's up and everyone's all excited, hey, I think the market's going higher, the speculators want to buy calls, so I'll open up my storefront and sell calls. And then whenever the market's down, all the bears get excited, hey, I think the market's going lower, so I want to buy puts, and I'll open up my storefront and buy puts or sell puts. So I'm selling, I'm not on the selling side. And so I'm selling the 28.55 put. It closed here at 29.50, so I'm about 100 points below it. So here's what it looks like over here. Here's my 3010 call. Here's my 28.55 put. This is a risk reward graph. Here's zero profit here down this vertical line, and anything to the right is a gain, $200 gain, $400 gain on the entire trade. This is one trade, these 4 legs. It's a 4-legged trade. I sell this call. I buy this call for protection. That's the 3020 call. I sold this put. I buy this put for protection. This is the 28.45 put right here. This is called an iron condor. And If the underlying stays in between the short call and the short put, you keep the premium that you collected when you first opened the trade, and that's represented by this gain over here. So this particular trade brought in $400 of premium. Now this was a little broken when I did this, but this is a little too extreme. But I brought in $400 of premium. I risked $1,000, so really I only have $600 of risk for $400 a gain. That's a huge gain, potential gain. But now if this index starts going outside this short call and this short put, then you're going to be in a loss. And here's the $600 right here. You can lose $600 on this trade. So I can either make $400 by risking 600. There's my potential profits here. My potential gains or loss is there. And this black line represents expiration. So at expiration, that's what it looks like. So if the index is stuck in this range, then you keep this $400 of premium. That's your profit. And during the trade, your profit and loss is going to be riding on one of these colors, these color lines, depending on how many days to expiration. 14 days to expiration is going to be on the red line. 10 days to expiration is on the blue line, et cetera, et cetera. Okay, so this is the risk reward graph for a four-legged option trade. This is called an iron condor. If I did just one side, it's going to be called a bear call spread on the top, or it's going to be called a put spread on the bottom, a bull put spread on the bottom. When you connect the two together, you get the iron condor. And then this is the underlying over here bouncing around. Okay, so summarizing this trade, we got the SPX October 11, 29.55, 29.45 bull put spread. So that's this. I sold this 29.55 put. I bought this 29.45 put for protection. It's a bull put spread. Plus, I sold the 3010 call. I bought the 3020 call for protection. That's called the SPX bear call spread. Add them together, you get the iron condor. The put spread brought in $130 of credit. Now this was the real trade. Something was wrong with this graph, but I brought in $130 of credit for using $1,000 because there's 10 points between this 1955-45 put spread. There's 10 points between the short leg and the long leg. There's 10 points between the short leg and the long leg. That means the broker will require $1,000 of maintenance to be held in order for you to open up this trade. So $1,000 is being held. I brought in $130 of credit for the put. I brought in $170 worth of credit for the call spread. That's a $300 worth of credit. 300 divided by 700, because the broker holds $1,000, but $300 of credit came into my account. So I'm just risking actually $700. 300 divided by 700 is a 43% return on investment for I think this was a 3 or 4 week trade. I open up now 2-week trades, and I'm bringing in about 25 to 30% return on each of the trades. And it's only for 10% of the portfolio. Okay, now for this one, it was for a 10K portfolio, 300 over 10,000 is a 3% return. And if you do that a couple times a month, there's your 6%. For what I do is I'm allocating 10%, and I might open 3 trades. So I'm trying to hit 5% a month. I don't want to push it much more than 6-7% a month usually under normal circumstances, but with the higher volatility, it's going to be a little higher. It'll probably be 7 to 10% a month through the election, through the end of the year, or really through COVID. Maybe that's going to be, the Q1 of next year. Okay, so that is an iron condor, and I constantly, for a typical $10,000 portfolio, it's all in increments of 10K. You use 10K, 20K, 30K, but you can start with 10K. That's the minimum. And I allocate 10% to each trade, and during steady state, I'll have 3 trades open. That's 30% allocated. Each trade's making 20, 30, 40%, and it's all additive. So every time I bring in a trade and I can keep the money, if it's a 30% gain, I brought in about 2%. I do it several times, and I can usually make up to 5%, 6% a month, 7% a month under steady state. Okay, so these are the returns. We're still sitting at 19.2% return now for the year, and I lost about 4 months, unfortunately. COVID was brutal. That took a lot of work. I got through it. You can see I have losing months, and I will have losing months when the market's moving that much because I have to move all the trades and continuously adjust them. But I'm through it, starting to book some gains. September, I'm not sure if I'm going to make a gain in September. I might have a loss or maybe a small gain. That's my goal. When you have a correction, like a 10% correction, like we just had, I'm not going to make a dime. I'm going to probably lose 2% or 1% or make a percent. My goal is, it's hard to make money when the market's making big moves. But now I was waiting for this. I wanted this. The market's pulled back finally. Now we're going to go sideways and choppy for a long time. And that's a beautiful thing. Okay, so consider trying Pinnacle for free. We can do the analysis for you, and it's recommended to auto trade this strategy where we do the trading for you because it can get fast moving. So we open and close all of the trades. No action is required by the client, and we make all adjustments. And things can get fast moving. So you can self-manage if you wish, but about 95% of our clients auto trade. Here are the strategies again. We got big cap, small cap, sector rotation. Big cap's doing pretty well. And sector rotation, I'm starting to feel comfortable in getting back into this market and following sectors. Diagonal covered calls coming soon. And this is going to be really interesting. So that's a blend of both revenue generation coming in with covered calls, plus directional, letting the call run whenever a stock or index starts climbing. Iron Condor Pinnacle, just talked about it. And then the leveraged dividend income. And this is a good replacement for bond funds, and it generates more. So we get about 10 to 12% annually, and we're extracting out the dividends. That's what we're extracting out. So we'll have stocks like AT&T and Verizon, then we'll lever it up, get the dividends up to about 3 to 4 times their normal level, and then we open up hedges, and it's a very elegant, powerful strategy. Okay, that's all I have for you guys. And if anyone has any questions, let me know. Okay, James has a question. Okay, so he's asking about, he wants to know more about the diagonal covered call. So diagonal covered call is for upside options. We're going to be buying a leap. That's a dated call, long call on a basket of stocks. So these will be good stocks, high quality stocks with good growth that could break out and climb. And that's perfectly fine with us. But they don't climb all the time. I mean, half the year, many times the stock is doing nothing. It's going sideways, and that's where we can generate income with it. We can write covered calls on it. And the minute it breaks out, our indicators tell us when to stop writing the calls and when to let it start running. And because it's a call, you can get a lot of gain out of it. And so some of the stocks that we've had over the last couple of months, they went up 300%, 200%. So we'll be booking the gains on those a little earlier than that. If we get a 50% gain on a stock, we're going to take it and not get greedy on it, because we know once it goes up, it's going to come back down most likely. And so it's best just to take your profit, don't get greedy. And we have mechanical stops on those where we'll be booking those profits at 50%, 70% on those calls, maybe a little lower, could be maybe down to 40%. And then once that stock is done running and starts getting more sideways and range bound, then our indicators tell us, all right, just keep on selling calls against it. And those are front month calls. Each call is usually open for 30 to 40 days. And then we're bringing in income on those. So that's called the diagonal covered call. Now, when we do that in QTR Capital, that's a registered firm for institutions. We're probably not going to be buying the leaps. We'll just be buying the stock itself. So we'll own the stock, we'll be writing covered calls on those stocks. Same thing, if the stock breaks up through certain levels and our indicators tell us to stop writing the calls, we will stop writing the calls. It's a very mechanical system. It's a systematic system. But we're not going to be seeing 40, 50, 60, 70% gains on a stock. We'll be seeing more like 10, 15, 20. And then we book our profits there. Okay, any other questions? Okay. I think Lisa has a question. She just wanted me to go over this risk reward graph one more time. Okay, I can cover this, and then I have another meeting I have to get to, and I'm running late. So let me just cover this really fast, and then we'll stop here. So this is how you open up the trade right here. We have a 3010, 3020 call, 2855, 2845 put. When you're writing credit spreads, you're selling the put or selling the call as your product. That's what you're selling. That's what the value is. And you're selling it to people who believe the market's going higher. These are directional speculators. They want to buy a call on the SPX. You open your storefront, you sell the call. So you sell the call, you sell the put, and you can do this literally every day. Every time the market's up, sell calls. And then every time the market's down, sell puts, because you can bring in more premium on those up days and down days. And you just do it over and over and over and over again. And I've been doing it for almost 20 years. So you just keep on selling calls, keep on selling puts. And the 3010 call is about where we want to be. Right now, this market, the SPX closed at 2952 right here. And you want to be up. We're usually bringing in, at least, well, for 2-week trades, we're usually bringing in $1, $1.20, $1.30. So that's about $130 for a quantity one. So $1,000 is being held by the broker. And now I'm bringing in premium to open up the trade. So I bring in, let's say, $130 on the top, $130 on the bottom. That's $260. That's about a 26% return if you look at it as $1,000, if your $1,000 is being used for your denominator. You actually don't, because you brought in $260, so you actually are not risking $1,000. You're risking $740. So that's what you use for your denominator to calculate your returns. And the return can easily be 30%, 35% for these trades. And they're all open up for 2 weeks. So we keep them open for 2 weeks, and we just keep on bringing in premium. And the key to this is that we have to know how to adjust, because we're right about 70 to 75% of the time we don't have to adjust. And then the other 25, maybe 30% of the time you do have to adjust. So the market starts moving up, and then we're gonna have to push this short call up. And sometimes we'll take the put and push the put up also. So you're constantly moving the trade. The market is the boss. You have to follow what the boss does. And sometimes the boss is very irrational, and you can't fight it. If the market's going up, the market's going up, whether you agree with it or not. So you have to adjust accordingly and react accordingly, and not get upset about it. You're just like, okay, my short puts are getting, or my short calls are getting under pressure. The market's going up. This index is going up. I have to push it up. And so you get pretty good at adjusting trades, and about 30% of the time we're moving trades. And then if the market corrects 7, 8, 9, 10% like it just did in the last 2 weeks, you're absolutely moving trades. So you have to push all your puts down. Now you can try to keep your exposure a little lower. Maybe you're making your best guess through your analysis. Hey, I think we're going to have a pullback. I'm not going to open any puts for the next week or two. You can do that. And sometimes it really works out nicely. Or you're like, all right, I usually open up 3 puts on the bottom. I'm going to open up only 1 for the next 2 or 3 weeks, because I think this market's going to pull back. So you have less exposure, but you still have to move something. You still have 1 down there, because you could be wrong. So now you have a put, push it down, push it down, push it down. I had to move these puts down 3 times already. And I think I'm finally done moving them. I'm getting close where now the market's stabilizing, the market's going to bounce a little bit, and it's going to get more sideways and choppy. And that's perfect for a trading strategy like a non-directional iron condor strategy. So that's how to do it. And the best way to learn is follow someone like me who's been doing it a long time. So that's what I do. When I want to learn a new strategy, I will follow someone that's been doing it for at least 10 years, preferably 10 or 15 years, and follow that person for a year. And I'll pay them their newsletter fee, whatever it is, and that will help me learn and not lose money unnecessarily. So that's what I do when I've been learning strategies. Okay, so that'll be the end of the presentation, and I'll just scroll to the end. And there's the website. You can sign up for free trials if you wish. You can email us at support@upsideoptions.net. And thank you very much for joining, and I'll see you next time. Thank you.